Hello, everyone. As you can guess, this portion of our course, being online, is going to have a number of bumps and bruises, but we're going to try to get through this as well as we can. I'm going to try to give you not only audio like I would in a regular lecture behind all of these PowerPoint slides, but I'll also make some slides and make sure then that you're able to look at the problems and then hear my discussion of the problems in the background. So here we go. Chapter 9 has a lot in it. Well, let's just take a look at some of those topics. The first concept included in this chapter is a review concept. It's the idea of the capital recovery. Remember that you don't report any gains until you've recovered all of your capital that you have invested in an asset. And also in this chapter, one of the first topics is the classifications of property. The property is classified not only by its use, but also its type. So we'll take a look at some of those right now. When we talk about property in this chapter, we're really going to talk about things that are long-lived type of property. So a lot of the things, for example, like buildings, land, machinery, equipment, vehicles, that sort of thing. And keep in mind then that the total amount invested, your cost basis in the asset, is not only the purchase price, but it's also all of the costs that you need to prepare the asset for its first use. And we'll take a look at these in the next few slides. These next two slides will define the three basic classifications of property based on their use, and then second, the next slide after this, the three basic types of property as defined by their type. What type of property is it? So as far as use is concerned, a taxpayer could buy a piece of property. It could be a vehicle, for example, to be used in their trade or business, and we follow the rules related to gains and losses on the sale and depreciation of trade or business assets. Could be purchased for the production of income or investment. For example, if they have some rental properties and they buy a car to be used in getting from one rental property to another. Or thirdly, they could finally be considered just personal use assets. It's not used in any kind of a business endeavor or an investment endeavor, but it's strictly for personal use. So again, three basic types of uses of property. You can use it either as a trade or business asset, or you could use it for the production of income, or you could use it instead for personal use. Another way that we can classify property is by its type. For example, is it tangible? Is it intangible? So we really, as you can see from this slide, you have what we usually call tangible personal property. And tangible personal property would be like machinery, equipment, vehicles, anything like that. We also have a classification of property that we would call real property, and tangible real property, usually they call it tangible personal property and tangible real property. Tangible real property is land and buildings, any land improvements like parking lots and roads and things like that. And then the third type of property, we could have intangible property. Now, intangible property is basically things like patents, copyrights, goodwill, all those things that don't have any physical substance. And so there's a really good table to summarize all of this over on page 9-6, table 9.1. I would highly recommend you guys look over that. And that is really a good definition of your three basic classes. And then the last category that you see on this slide, personal use property. The assumption is those first categories that you see there are used in a trade or business or for investment. But personal use property would be anything that you would buy that would be strictly that you are going to use for personal use only, whether that could be your house, your car, your furniture inside your house, anything like that. But when you get to this category, tangible, or try it again, personal use property, that basically means we are not going to use it other than for strictly personal use. Let's take a little bit of a look at each one of these types of property. This slide has on it the personal property. Usually they call it tangible personal property. Again, it has a physical existence. It basically would include most of the business assets that you would have other than real property, real estate. So anything like machinery, equipment, vehicles, computers, automobiles, trucks, furniture, and fixtures, all that sort of thing. These are called tangible personal property. And again, that table 9-1 on page 9.6 has a lot of good examples of each one of these classes. Again, I would ask you to be sure and take a look at that. The next category is tangible real property. And tangible real property, as I mentioned before, is land, buildings, any kind of land improvements that all would be considered real property. And these differences between tangible personal property and tangible real property will really be important when we get to the next chapter on depreciation, because of the fact that there are very, very different rules when you depreciate tangible personal property versus when you depreciate tangible real property. But as you can see here, anything that is built on, on the land, any kind of buildings, outbuildings, pole barns, anything like that, and then anything you would do in the way to improve your land. For example, like putting out trees and bushes and making nice parking lots and the cement bumpers that the cars pull up to and park against. Any kind of fences, like around Bonaventure, for example, any kind of fences that we have around the property, any kind of signs out front of the property, the big pole lights that we have around all the parking lots and so forth. Those are all considered to be land improvements. The next category is intangible property, and you guys are all familiar with that with the other accounting courses that you've taken. This is the property that is basically, I would define it as long-lived legal rights. Intangible property are really, for the most part, legal rights. And so it doesn't have a physical substance. It basically only exists on paper and so forth. And again, table 9.1 on page 9.6 is a good list of the intangible property items like patents, copyrights, trademarks, goodwill, covenants not to compete, and then also consider for intangible property stocks, bonds, and other securities, in other words, investments that you would make. Finally, we come to personal use property, and that's pretty self-explanatory. Anything that you would use just for your own personal use, your personal car, your personal residence, your personal lawnmower even, anything like that you would have for personal use. And then I note here on the bottom of this page, remember the rules are not the same when you sell personal use assets. If you have a gain on the sale of personal use assets, they are taxed as capital gains. But on the other side, if you have losses on the sale of personal use assets, unfortunately, these are non-deductible personal losses, and you can't take any of the deductions for that. For example, you sell a personal use asset, there's no way you're going to get any of that $3,000 capital loss, even though the flip side, if you sell it at a profit, you do have to report capital gains on that old car that you had out back and you managed to sell for a little bit of a profit. So it works one way, but it doesn't work the other.